Hello friends, today we will look at McDonald's. Most of you probably know what this business is about, so I'll jump straight to the company's financial performance. It can be seen that the company's revenues are constantly changing, as are the preferences of their customers. Net income also doesn't follow a steady trend, but the company almost always generates a little over $5 billion. The company's assets are gradually increasing. However, the company's debts show a more stable upward trend compared to its assets. Moreover, the company is aggressively buying back shares from the stock market. Before I rate the business, don't forget to subscribe to my channel so you don't miss my future videos. I rate this business 5 out of 10. The company has one of the most powerful brands in the world, operating on all continents. When it comes to fast food, the average person is likely to choose McDonald's. The company actively invests in menu development and marketing, which helps adapt to their consumers to consistently generate profits. Unfortunately, that's the only positive thing I could say about McDonald's. In my opinion, the business is shifting from being excellent to average because more and more competitors are emerging who, in my view, are not lagging behind. In this case, the only advantage McDonald's has is its rich history and customer loyalty, but unfortunately, that's not enough. The company has been reducing its own restaurants for several years because they have ceased to be profitable, and that's how the company achieved nearly 95% of all restaurants operating under their franchise. It seems to me that the company has reached its potential and can no longer grow, which means that if this business remains stagnant, other fast food companies investing in development will gradually push McDonald's out of the leading positions. The company also faces many challenges such as high product prices, changing consumer preferences towards healthier food, and legal challenges like a $20 minimum wage for workers. Ultimately, this is a business focused on profit, and if the brand ceases to be profitable, franchise owners will simply start closing. After the law mandated a minimum $20 hourly wage, the company had no choice but to pass these costs on to customers. Additionally, prices were already rising due to inflation. As a result, the company started losing customers because fewer people in the current economic climate could afford fast food. Now the company is forcing its franchises to bear losses through offers like a $5 combo to regain these customers. I believe this is a big mistake because this offer is not profitable and does not change the surrounding economic situation. In other words, the company is simply giving money away to its customers. If I were the brand owner, I would agree to such conditions only if they reduced the franchise fee percentage because I don't see any other way to survive, otherwise, I would just close the restaurant. So now we can see that the company opens thousands of restaurants annually, but the company's revenues do not grow, which only means that older restaurants start generating less revenue. Although the company's net income has increased recently, let me remind you that today this is a business almost entirely run through franchises, so these figures can easily be manipulated considering the company constantly closes its own stores and also takes an initial fee from franchise owners of a few $1,000,000. All this has led to the company now having more debt than assets, and from this point, things will only get worse. The thing is, the company has money but cannot change this situation. All the company can do is increase dividends and buy back shares from the stock market. Today, you can buy the company's shares for about $262, and I think this price is too high. I would only buy the company's shares if I saw a price of $180 per share. Subscribe to my channel so you don't miss my future videos.